Hey, what's up, class? Before we get started, I have some announcements. Okay? I need to highlight and thank some people as we close out 2018 and enter a new year with new goals, new hopes, new dreams, new passions, new wants. Okay? So, at first, I want to shout out the Kendrick family: Miss Jasmine, Miss Proc, Mr. Shepard, Mr. Sanford, Mr. Carter, Mr. Lynch, the Lynch family, the Neverson family, Cheryl, thank you, and Mr. and Mrs. White. Okay, these are my top contributors on the Patreon page. Okay, and also want to shout out my very first supporter ever, Mr. Houston. Thank you so much for your support. I want to thank all my contributors and loyal patrons, as well as my loyal subscribers, putting in the time. I see it. Did you know we're well over 1.2 million minutes watched? Okay, and on the analytics, 1.2 million minutes, and there's only what, 2,300 subscribers? Not bad. Not bad. We're doing good. We're growing something big here. All right. And I also want to highlight my top contributor who has given the most so far, and that goes to Mr. Lynch. Okay. Thank you so much for committing for as long as you have. And I know that you're getting results. Okay. I know that your son-in-law is getting results as well. That trucking business is going to explode. Okay. We're going to get results. Okay. And I want to go ahead and give some more, because you know how I am about this giving thing. Okay. I'm big on it. Listen, anyone in the month of December, whoever joins at the tier 3 level, okay, between now, December, what's today? Oh my God, December 4th, and throughout the rest of the month, whoever joins at tier 3, I'm going to give you a shirt. Okay, you've noticed I've been wearing some shirts. I got some different designs. A friend of mine, my confidant, made this. He made me in a shirt. How cool is that? I love it. I'm like, that is pretty crispy. I like it. So, website is coming soon. Okay, it's going to drop on my birthday. My birthday is January 4th. Okay, so my website will release on my birthday. That'll be a gift, not only to myself, but to you guys as well. You guys get to see the progress. As well as I'll be selling shirts starting on January 4th. But for the people that join at tier 3 this month are going to get shirts in the mail. Okay. And if I can pull it financially, if I can do it, I also want to send shirts to my other tier 3 contributors that have been contributing for more than a month. Okay, so if you were at my tier 3 for more than 2 months, I'm going to look at everything, and I want to, if I can pull it, if I can financially do it this month, you'll get a shirt. I'll call you up, be like, hey, what's your shirt size? Small, medium, large? All right. What color? What's your favorite color? Okay, cool. Boom. That'll be my Christmas gift to you. Okay? Now, going into the lesson, we are talking about the infinite banking concept, which is life insurance as an asset class. The purpose of it is to use it just like you would a line of credit to do velocity banking with, to do what? Acquire real estate, acquire business, pay off debts, make investments, make your money make more money, to continue making more money, because if you don't continue to increase your life and increase and expand, you're going to contract. and you're going to wither away and die. And we don't want that, all right? We want to build your legacy, right? So the infinite banking concept is a key component to your personal finances. So today we have an individual, 26 years old, male, and we had a discussion, doesn't have a lot of debt. So he's going to be debt free by like midway into next year, 2019. So he was like, yo, I really like this concept. I want to apply this and get it going. At the same time, I want to be building my, my life, my real estate, business, investing, yada, yada. I'm like, okay, cool, man. Let's do it. So we said, all right, annual funding into his tax-free bank is going to be $7,500 a year for 30 years. So he'll be 56 when it's all said and done in terms of the funding period. Well, you times that by that, you get $225,000. His MEC limit, since he's so young, he's going to have a nice space for very little cost. So his MEC limit is $22,000, times that by 30. The max amount of money that he can put into this policy over the course of 30 years is $660,000, okay? And his cost to do so is going to be around this number per year, $1,953.50. If you were to times that by that, your cost of insurance is right around 26%. Okay, so over the course of 30 years, he would have paid to the life insurance company, because we're buying life insurance. We're not buying an investment. We're buying an asset class, okay? His cost would be $58,605 over the course of 30 years. Okay, you times that by that number, you get about it, still 26-27% cost, right? This percentage is a direct correlation to the MEC limit, okay? The reason why we have that MEC limit much higher than his contribution amount is because he's a very young individual. Not only that, it's what he desired. So whenever I'm designing a policy, or my team is designing a policy, and we're mapping out what you want, how you want it to look, every case is a case by case, right? Very particular, critique, personal, catered to you and your family. So for this individual, this is how it turned out, okay? So his goal should be to get to that number per year. He wants to increase it. So I drew out a bit of a plan. I'm going to show you the conservative route, and then I'm going to show you an aggressive route, okay? So conservatively, if all he did for 30 years was put in $7,500 a year, his total cash value would be somewhere a little bit above $450,000 at age 56. Not bad for a savings plan. His face amount, or AKA death benefit, will be 1.2 million. Okay? But notice how year one, his cash value will start at 5K. And year one, his face amount or death benefit starts out at 911,000. So both the cash value and the face amount continue to increase over time for as long as he continues to fund the policy. Pretty cool. All right. Now, what's really interesting as well, conservatively, is if he were to stop funding it after 30 years, so after age 56, his policy is going to turn into what's called a reduced paid up, which basically means that he is no longer going to be paying for life insurance because he paid it all up in the beginning years. He paid up all his life insurance, so he'll never have a cost again. What's very interesting though is that every year thereafter he's going to start hitting his critical mass, which basically is saying that even though he's no longer funding it anymore, right? He's no longer funding the policy. His cash value will continue to increase no matter what. No matter what. How cool is that? That's pretty cool. So at age 65, he goes from 450 to 715,000. And then to 80 years old, he's at 1.4 million cash value. And then we look at the death benefit. It went from starting out at 911,000, it grew to 1.2 million by age 56. By age 65, he's at 1.3. Okay. And then it continues to grow. Age 80, 1.9 million. Okay, you know what? That is false. That is a mistake. I have to check that. Okay, that is actually a mistake. There's no way that that could be possible, because we would get a Mac. So that's not good. I got to see what I did wrong there. Maybe you guys can help me out. All right, so to recap, we have age 56, right? It's conservative, putting in that much, 30 years, 450,000. Face amounts at 1.2 million, right? And then age 65, his cash value grew to 715,000. And then age 80, 1.4 million. You know what? I think those numbers are correct. Yeah, they are. They are. Never mind. Wow. Sorry about that. Sometimes I make a mistake, you know. I'm still a little young, so, you know, trying to grow. But here's why it's not a mech. See the cash value and the death benefit? And then over here, cash value and death benefit. Cash value must always be lower than the death benefit. Why? Because we do not want to mech out. Okay? If we were to mech out, this whole entire concept would be destroyed from this word right here, tax. The IRS is going to say, hey, sir, you've been funding this policy sort of like a 401k, like an IRA, and you overfunded it too much, where the gains, which are 4 to 6.5%, you know, working with the four major mutuals as of 2018, the dividend rates are anywhere from 4 to 6.5%, and that's tax-free money, right? Kind of like a Roth, okay? But with the Roth, there's no management fees, broker fees, and there's no risk to your money. You can't lose your money inside of a life insurance policy. So, but what could happen is if you were to overfund this thing, and the IRS is going to say, hey, listen, we're going to treat this policy like a qualified retirement account, like a 401k, like an IRA, like an TSP, a 403b, you know, 50 this 9, and the okay? IRS is going to tax you on all the gains, and then so much for your tax-free growth, okay? So we want to avoid that, right? So if he was to do conservative, he'll never have to worry. He's just putting in $7,500 a year, and he's got this huge mech, okay? Never have to worry. The money is safe. It's liquid. When I say liquid, I'm referring to the cash value, okay? Whether it's in the very first year or the 15th year or the 30th year or every year thereafter, he will be able to pull this money out and use it to do whatever he so pleases with, okay? So that's the conservative route. The aggressive route is not really that aggressive. It's just an idea of increasing his funding by 1,000 every single year, okay? And what I did basically was, all right, every 4 years, we're going to increase his annual fund by 4,000. Okay, so for the first 4 years, he's putting in 75, 75, 75, 75, 75. Cool. Year after that, he's going to increase it to 11,500. Okay? Denzel, how can he fund this policy? What are some ways that he can fund this policy? Well, if you do velocity banking, you can fund this policy and continue to never lose your cash flow in the process, right? Where we use a line of credit, right, to acquire the asset. Why am I writing with my right hand? That's crazy. Asset, which then pays us back the cash, which then gives us the ability to keep doing it over and over again, which is nice. The interest that he'll earn here will offset the interest that he pays on the line of credit, and then his cash value is in all three places. Whether it's in the checking account, right, the line of credit itself, or the asset, the policy, the property, the business. Pretty cool, right? Okay. So he increases it to 11,000, another 4 years, boom, bumps it up to 15,500, another 4 years, bumps it up to 19,500, and then every year thereafter, he just stays at 19,500, okay? The total amount of money that he would have put into the policy would be $489,000, okay? That's a little over double 225, a little over double 225. So we can conservatively say that if I put double the amount of my funding by age 56, if the conservative route was 450, a little over 450, then we can conservatively say that he'll have 1 million in cash value by age 56. Not bad for a savings plan. Okay? And by the way, all this money is tax-free if designed properly. Okay? All tax-free if designed properly. Now, his face amount, death benefit, age 56, again, if it was at 1.2 million, the conservative, then, just double it. And I just said, all right, it should be at like 2.3, 2.4, maybe a little higher than that, probably like 2.6. But it's conservative, all right? And that's not bad. This is a nice fund to do some fix and flips with, some wholesaling, get a rental, a duplex, a triplex, right? A quad. Who knows? Whatever you like. Or just fund your own personal business, right? And to me, he is establishing a kingdom, a successful kingdom in his household, okay? Where he's using velocity banking, line of credit, to maybe acquire the policy, or maybe he just uses cash, okay? Acquires the policy builds money, gives him the ability to invest money over time, because my rules when it comes to investing. I follow what Grant Cardone does, and Tony Robbins and Warren Buffett. Is number one, you invest in yourself first. Number two, you invest in what you know, okay? And before you do the invest in what you know, okay, my goal is to build about 100,000 in cash, or cash line of credit, or cash checking account, okay? Before I make an investment in any other vehicle outside of my personal, gotta understand this, my personal finances, your personal line of credit, your personal life insurance policy, your personal checking account. This is all your personal finances. Look at the results. Money based off your personal. Imagine if you and I started a business together. Imagine if you started learning about sustainability and learning about, investing in maybe some Forex or some crypto, investing in real estate. Oh my. Is your when I go to your kingdom and we hang out, oh, the food that we're going to eat together, the fellowship that we're going to engage in, the worship, the prayer, the giving that we're going to be able to do together. Wow. Wow. Listen, my name is Denzel. I hope you enjoyed this concept, this teaching, this lecture. Excuse my little mistakes every now and then that I make. It's part of the growth. It's part of the process. Thank you so much for viewing. Again, thank you to all my contributors. Love you very much. If you're here for the first time, welcome, my friend. Welcome. All right. My name is Denzel. Enjoy the rest of your day, and God bless.